Also, we can CPE training registration. CPE ಇದು
Manish,
Yes, sir.
ಓಕೆ. ಚಿತ್ತದ ಅನುಭವ ಭಾವ ಸಂಭಾವನೆಗಳೆಲ್ಲ ಬತ್ತಬದನು ವಿಚಾರಯುಕ್ತಿಗಳು ಕುಟ್ಟೆ ತತ್ವ ತಂಡುಲ ದೊರೆ ಎಂಬುದು ವಿವೇಚಿತ ತತ್ವ ನಿತ್ಯ ಭೋಜನ ನಮಗೆ ಮಂಕುತಿಮ್ಮ. The feelings, experience and merits of inner conscience are like paddy with husks, beating with reason, logic, examination and arguments. You will find the real meaning. Only then you enjoy it daily. Mankutima. A very good evening, members. C. Rabindra Koreer, Chairman of Bangalore branch of SIRC of ICAI, wholeheartedly welcome you all for the 91st Dasoha live webcast session from the Bangalore branch. Today's topic is on the happening, the every moment, the happening. What is the criticality we are facing day to day? That is none other than nothing. This is a GST on GST. It is a GST and critical issues is going to be handled by, because normally when the word is critical, then only people of expertise will come. So we have with very expert personalities with us, advocate from Mumbai, Sri Shailesh Seth, on behalf of all the viewers and managing committee members of Bangalore branch. I wholeheartedly welcome Advocate Sri Shailesh Seth sir for the today's session. Welcome you, sir. Dear members, I wholeheartedly welcome you all for the 91st Dasoha live webcast session from Bangalore branch. The today's topic, it's in cover controversies surrounding aggregate turnover, taxable supply, exempt supply and non-taxable supply. And section 16(2)(c), the precondition for availment of ITC, scope and issues. Section 16(4), time limit for availing ITC and analysis. Levy of GST on liquidated damages, penal interest, etc. Is it valid? Rule 36(4), restriction on availment of ITC and analysis. New invoicing system, philosophy, scope and implications. This all topic will be covered by the Sri Shailesh sir. Dear members, you know, Advocate Shailesh sir is a more experienced personality, and the topic is it is lucky that today is addressing from Mumbai. So we are fortunate to have Sri Shailesh Seth sir with us. Once again, I wholeheartedly welcome Shailesh Seth sir for the today's session. Dear members, after that, tomorrow we are having a special session from Income Tax Department on ITR 7. The link will also be today evening. We are sharing with email to all the members. It's not a program from Bangalore branch. Income Tax Department of Karnataka is having the program. They requested to share the information. Definitely, we are going to share in today evening. After tomorrow, day after 17th, 18th, and 19th, we are having an international conference from our head office. So that's the reason Bangalore branch is not hosting any programs. Our next Jnana Dasoha will be on next Tuesday, 22nd December, on professional opportunity for financing options for MSMEs and startups by CA SS Nayak is going to address. And after that, we have a 2 days women conference session virtually, 23rd and 24th. So it is not, we are not going to restrict any men also for the attending the programs. And after that, 30th December, we are having session on code of ethics from our central council member CAG Sekhar. With that note, once again, I wholeheartedly welcome all the viewers and today's speaker. Now I request CA Panindra Gupta to formally introduce the today's speaker. Over to Panindra.
Thank you, Kore sir. So today's speaker doesn't require any introduction only, but for the sake of new members, so Shailesh sir is an advocate and a become graduate and has over 30 years of experience in consulting, advisory and litigation practice in the field of indirect taxes that includes central excise, service tax, customs, state VAT laws, CST and GST. Shailesh sir is also one of the partners in a legal firm, RVS Legal, so which is based in Chennai, Bangalore and Mumbai with esteemed partners Raghuraman sir and Vaidiswaran. Shailesh sir has also been regular faculty at various professional bodies as well as trade and industry forums on his chosen field. He has also delivered more than 80 lectures since April 2017 on various aspects of GST all over India. He's a regular columnist in Vyapar, a bi-weekly business newspaper of Janmabhoomi Group on service tax, central excise and GST, and has also contributed a number of articles to various magazines as well as taxation websites like TIOL, etc. With this brief introduction, I welcome today's speaker, C.S. Ellis, sir, for today's session. And over to you, sir. Sir, you need to unmute, sir.
Good evening to all of the friends. And Mr. Paninder, only one thing before we start the discussion. I had actually not downloaded this application. I'm running on a temporary application. I mean, I hope there will not be any disruption in the meeting.
No problem, sir.
No problem. Okay, fine. Good evening to all friends. For another 2 hours, we would be, discussing certain extremely complex and critical issues, which are almost every now and then hogging the limelight as far as the GST is concerned. None of these issues, the legal position is yet settled. So there are going to be a lot of fireworks, even though there is a complete ban on the firecrackers. Still, there are going to be much more noisy and much more lightning fireworks you can expect in the coming days on all these issues. Altogether, I am expected to cover 6 topics. The last topic about e-invoicing, I was slightly, while discussing with the branch, I was slightly, in a dilemma whether to cover that topic or not. But since the newsletter was already out, we did not disturb it. I will just if the time permits, I will take up this topic, because that topic basically will, need a separate session altogether. My idea was to include that topic initially was to where the international jurisdictions are actually on this particular aspect of e-invoicing. It is not that India has only taken up the e-invoicing. France has already introduced it in January 20 and by April 23, and then finally by 2025, France is expected to almost, complete be switching over to e-invoicing. Many other international VAT or GST jurisdictions have also actually shifted to e-invoicing. Therefore, it is very necessary to understand the philosophy behind this entire new initiative world over, and what are the pros and cons, what are the advantages and disadvantages for either side, revenue as well as the taxpayers. And in the context of India, the e-invoicing provisions which are being introduced or have been introduced on a selective manner, then what is the scope of that? I wasn't planning to, and I would normally not go into the technical aspect, how the system will work. I am sure my chartered accountant brothers and sisters, they are much more competent to deal with the technical aspects also, much more. I wanted to, the people to understand about the philosophy and the analysis of these provisions. So if time permits, we'll deal with that. But otherwise, I would not rush through the topics. So maybe some other time, in future. With these opening words, friends, whenever I have any occasion to say anything on tax, and obviously, be it service tax, excise, customs, or GST, of late, the new flavor of the season since last 3 years, I am always fondly reminded of one of my very favorite quotes by the Hugh McLennan, who says, "Man is a thinking animal, a talking animal, a tool-making animal, a building animal, a political animal, a fantasizing animal, but in the twilight of civilization, he is chiefly a tax-paying animal." So we are all destined to be tax-paying animals till we breathe our last. As it has been very rightly said, death and taxes are the only constants in this ever-changing world of the human being. And it is also interesting to note, and one must note this, that taxes are keeping the company with death, not with anything else. So if one wants to rid of the taxation burden ever, maybe one has to really breathe his last. Only on the death, probably the taxes will go away. Fortunately, there is no estate duty so far. So with these sober words, let me take up the first topic. And from at this very moment, my dear friends, I am fully aware that I would be opening up probably I would be opening up the Pandora's box. Maybe sometime at the end of the session, I will share some thoughts on this Pandora's box. A very interesting story. It is a myth that I would share with them. So here we go. The first topic is obviously about the concepts of the exempted supply, taxable supply, non-taxable supply, zero-rated supply, etc. One thing, I'm sure the organizers must have actually, advised everybody. At the end of this 2-hour session, I would also deal with the question answers. As far as I am concerned, now this entire evening, I'm completely devoted to Bangalore branch. So I have no restriction on the timing. Depending upon the convenience of the branch as well as the participants, I will be at your disposal. I will try to deal with as many questions as much possible and which are actually possible to be dealt with in this particular session. I will deal with it. So the first topic, please come to the next slide. Can you please change the slide, please? Yes, next. The initial 17 slides are mainly I have taken up. I have mentioned about the, only about the statutory provisions. By the way, this entire presentation will be shared by the branch with the participants. There are some few corrections because I prepared this only in last couple of days. Was not having much time to do anything. So there are some correction I would make today night itself. I will again resend it to the branch, and branch will actually, share it with all the participants as per their protocol and as per their, convenience. For the purpose of this particular topic, please look at the definition of aggregate turnover. Aggregate turnover means the aggregate value of all taxable supplies, excluding the value of inward supplies on which tax is payable by a person on reverse charge basis, exempt supplies, exports of goods or services or both, and interstate supplies of persons having the same permanent account number to be computed on all India basis, but excludes central tax, state tax, union territory tax, integrated tax, and cess. Please keep this definition in mind. Next. Section 2, subsection 47. Exempt supply means supply of any goods or services or both, which attracts nil rate of tax or which may be wholly exempt from tax under section 11 or under section 6 of the IGST Act and includes non-taxable supply. Next. Non-taxable supply, section 278, means a supply of goods or services or both, which is not leviable to tax under this Act or under the IGST Act. Next. Next. Prescribed means prescribed by rules made under this Act on the recommendations of the Council. Registered person means a person who is registered under section 25 but does not include a person having a UIN. Services means anything other than goods. I will not read the full definition. Taxable person means a person who is registered or liable to be registered under section 22 or section 24. Taxable supply means a supply of goods or services or both which is leviable to tax under this Act. Next. Turnover in state. The section 2 subsection 6 defined aggregate turnover. Now we are talking about turnover in state or turnover in union territory. Means the aggregate value of taxable supplies, excluding the RCM supplies and exempt supplies made within a state or union territory by a taxable person, including exports, interstate supplies, but excluding the taxes. Then Section 11 has got the, it contains the provision empowering the central government on the recommendation of the council to provide for the exemption, whether partially or fully, wholly, and whether conditionally or unconditionally, the exemption from any services, supply of any services or goods or both. This is the, basically the empowering section for the purpose of exemption. Next. Next. Now, with this statutory provision, keeping them in mind, let us now see what is the concept of aggregate turnover. What does it mean and what it includes and what it does not include. Aggregate turnover and turnover in state or turnover in union territory, friends, if you would have very carefully seen, the aggregate turnover concept encompasses everything, whereas turnover in a state, which is used very selectively in certain provisions, it speaks about the turnover in a state or union territory only. Basically, there is a purpose behind this, which I'll come to later on. Now, what does it include? Aggregate turnover includes all taxable supplies, and taxable supply has also been defined as a supply of service, goods or services or both, on which tax is leviable under this Act. So taxable supply, exempt supplies, export of goods or services or both, interstate supplies of a person with the same PAN number, but excludes any supplies, inward supplies received by a taxable person on which the tax is leviable to under RCM. In other words, for any services received by a registered taxable person where he is required to discharge the tax liability under reverse charge mechanism, that would not be computed for the purpose of his aggregate turnover. It will be computed ultimately in the turnover of the actual supplier vendor and not in the turnover of the recipient. Please bear it in mind. So if a person receives, a taxable person receives, say, my services and advocate services are under reverse charge mechanism. In that case, the value of the invoice which I have raised on my client, the advocate has raised on his client, would not be computed on the client's turnover. And it also excludes the taxes, but bear it in mind, the which taxes are excluded? Only the taxes payable under the GST laws. Central GST, state GST, union UT GST, IGST, or GST compensation cess. These are only excluded from the scope of the value of the supplies and for the purposes of determination of aggregate turnover. Before we further go into this, there is a very interesting departure in GST from the erstwhile excise and service tax regime. And this differentiation, this departure from the erstwhile philosophy should be very, very interesting and should be kept in mind. Right from the day one in central excise, when in 1986, when the small scale exemption came, central excise tariff act came, moderate, which is basically the great grandfather of the today's input tax credit, when the moderate scheme came, in the under small scale exemption notification, always the aggregate value would have been used. The exemption on the first clearances and the aggregate clearances. So initially it was 7.5 lakhs first clearances were exempted, subject to the condition that during the financial year, the total aggregate value of clearances should not have actually exceeded 25 lakhs. That 7.5 lakhs have become 1.5 crore till 2017. Finally, by 8/2003 central excise notification, and the eligibility criteria became 4 crore. However, for these first clearances, exempted clearances of 1.5 crore and the 4 crore turnover also, the exports were never taken into account. The exports were always kept outside for the purpose of computation. And I have to arrive at my eligibility threshold by excluding the exports. Similarly, the service provider notification, original notification 6/2005, and the subsequent notification 33/12, which came after the negative list of levy of services came, then In both the cases, if you very carefully read that notification, it did not include the export of services. Another very important point in the erstwhile regime which was prevalent was, and this was not only the practice after 86, even prior to 86 also, there were notifications, small-scale notification, 80 by 80, and there were other notifications also. I'm not going into too much details. But exports were always excluded, and even for the purpose of first clearances, which were basically the lower limit, which were exempted, even wholly exempt goods were also not required to be taken into account under any other notification. There were notifications and notification, and if the manufacturer was engaged in more than two products, one product is exempted under a different notification, then its turnover would not be computed for the purpose of small-scale exemption turnover. This was actually the practice which was in the vogue for more than almost for the 4 decades under excise, and even for small-scale exemption, it remained a practice for almost since 2005 onwards, for nearly 15 years. Now, under GST, this the benefit or this policy has been done away with. Aggregate turnover now includes even exports also. This is the first point one has to keep in mind. Not only that, aggregate turnover also includes wholly exempt clearance. So for a 20 lakh exemption or 40 lakhs exemption or 10 lakh exemption, we will see that for the purpose of registration, section 22, the aggregate turnover will have to be determined by taking into account the exports also and exempt clearances also. Other important point is about the exclusion of only the GST taxes paid under GST or sales paid under GST. If you see section 15 subsection 2A, you would find that any taxes, duties, charges, fees, etc. paid under any other law for the time being in force shall form the part of the value, taxable value of a given supply. So the sum and substance is this. Basically, the idea behind including these are twofold as I see this. That one, that by excluding the wholly exempt supply or export, a sort of a differentiation or discriminatory treatment will be given to vis-a-vis two class of taxpayers. A taxpayers engage in the supply, taxable supply, and a taxpayer engage in the taxable supply not only for domestic market, for export also, or for the purpose of another supply which is wholly exempt. Since neutrality is the cornerstone of the GST or the VAT philosophy, the policymakers must have thought that there is now no need to exclude from the scope of aggregate turnover the export turnover or the exempted turnover. Another piquant situation could have arisen if export or exempted turnover is excluded from the scope of aggregate turnover. Suppose a person's aggregate turnover is less than the threshold, say of 40 lakhs. However, is exempted turnover of another product which is wholly exempt under, or another supply which is wholly exempt, might be running into 10 crore. Then he would still be entitled for the threshold exemption and not liable to be registered, even though his total turnover is much, much higher. Because if the exempted turnover is not included in the aggregate turnover. So, and this could have led to not only the anomalous situation, ultimately it would have led into the very chain, the chain of the seamless chain of the ITC would have broken in the process, and it would have created a lot of distortions in the system. And therefore, considering the overall comprehensive, view, with on one hand, the value addition principle, on another hand, the seamless ITC, third, neutrality, keeping all these aspects into mind, it appears that the aggregate turnover has been very, very widely worded. Next. Coming to registration threshold, section 22. As you know, different thresholds for the suppliers of goods and suppliers of services, and for the special category of states, mainly northeast bound, and other states have been provided for. I'm not going into those details. And here under section 22(1), aggregate turnover word has been used. This phrase has been used there. It says, clause 1 of the explanation says, for the purposes of this section, the expression aggregate turnover shall include all supplies made by the taxable person, whether on its own account or made on behalf of all his principals. I'm sorry, it is not principals, it is principals. So the question here is whether this explanation, this clause, it is at the end of the section 22, whether this clause will prevail upon the aggregate turnover definition under section 2 subsection 6. The answer is no. Aggregate turnover definition of section 2.6 will always be all encompassing. It will be all pervasive. However, this explanation is meant to further actually remove the doubts that not only all the supplies made by the taxable person will be included, but even if a person is making any supplies as an agent for his principal, then it will also be covered within the aggregate turnover for the purpose of registration threshold. So this is basically, clarificatory type of explanation that one need not, that person need not only compute his own turnover, but even if he is acting as an agent, even on behalf of his principal, whatever turnover is made by him, that would also be counted for the purpose of aggregate turnover. Clause 2 of the explanation says, the supply of goods after completion of job work by a registered job worker shall be treated as the supply of goods by the principal, referred to in section 143, and the value of such goods shall not be included in the aggregate turnover of the registered job worker. Please keep this particular clause very much in mind. Section 143 basically allows the movement of the goods for the job work purpose without payment of tax by either side. This explanation says, whenever a registered job worker completes the job and supplies the goods, the processed goods to the principal, in that case, the value of the such goods shall not be included in the aggregate turnover of registered job worker, because it was originally the principal's goods only. He has sent some raw material. That raw material has been processed by the job worker. Job worker is now sending back the processed goods. The value of that processed goods, which are in the nature of, once it is final product, that will be counted as a principal turnover and not the job worker turnover. So for the purpose of job worker threshold for registration purpose, this turnover will not be counted. These two aspects shall be kept in mind. Here, let me point out one very important thing, friends. Unlike the previous excise and service tax regime, under GST, there is no specific small-scale exemption notification, whether for service providers or whether for the manufacturer or trader in the goods. What is being provided through the section and not through the notification is the registration exemption from registration. The limit is thereafter by notification 10 by 2019. The limit has been enhanced to 40 lakhs, and this is a different matter. But the fundamental, the exemption from registration is embodied in section itself. There is no exemption from payment of tax per se to the small-scale service provider or small-scale manufacturer under GST. It does not speak about exemption from tax. It speaks about exemption from registration. But if I am engaged into the taxable supply, my liability to obtain the registration is mandatory under the law. Therefore, the very fact that I am given the benefit of exemption from registration, it would mean that up to this threshold, I am not required to make payment of tax. So both are going together. Both are basically two sides of the one coin. Having said that, the elaborate conditions which one would have found under the small-scale exemption notification 8 by 2003, what should be included and what should not be included, or 33 by 2012 for the service providers, no such elaborate conditions are now laid down, except whatever conditions are provided in the section itself. This is another very important departure from the erstwhile practice. The one reason could be that the conditions are embodied in the section itself, and aggregate turnover has been defined also in the parent act itself. One important significant aspect of GST law is that earlier what were used to be provided by the rules or notifications, particularly by the rules, one would now find it as a part of the Parent Act itself. This is a very interesting departure. Like, for instance, the provisions relating to input tax credit. I'm slightly taking some departure for a couple of minutes. Provisions relating to input tax credit. Earlier regime, it were all contained in the Senvet Credit Rules 2004. But now, there are substantial provisions which are contained in Section 16, Section 17, Section 18, and the rules, the machinery provisions in the form of rules are there dealing with the ITC. But the overall framework has been laid down under section. Similar things you would find in many aspects which have been dealt with in the Parent Act. It has two implications. One, because they are part of the substantial provisions of the Parent Act, and therefore the overnight amendment of that will not be possible, and it brings some sort of a certainty in law, because we know that Act, the substantial Parent Act cannot be amended through the notification. At the same time, if there are lacuna, there are infirmity, there are anomalies in the Parent Act, any provision of the Parent Act, that is CGST Act, it cannot be corrected overnight, and any significant amendment which is required to be brought in, whether prospectively or retrospectively, that also cannot be done overnight. For instance, first proviso inserted in Section 50 relating to interest, it had to wait now. Correct? Many provisions, so it has it has its own advantages also and disadvantages also. Anyway, now, so this aggregate turnover, coming to the composition scheme, Section 10 provides for the composition scheme. It is a complete framework by itself. It is a self-sufficient provision for composition scheme. Eligibility threshold is 150 lakhs, but certain specified states, it is 75 lakhs from 1/4/2019. Next. Here, there are two explanations, even in Section 10. Aggregate turnover to include value of supplies made from 1st April of a financial year up to the date of becoming liable for registration. So when a person becomes liable for registration, all the value of supply made from 1st April up to the date of he becoming liable for registration will have to be computed for his 150 lakh threshold. However, it would not include value of exempt supply of services by way of extending deposits, loans or advances insofar as the consideration is represented by way of interest or discount. This is to be excluded for the purpose of computing 150 lakhs if a person wants to claim the benefit of composition scheme. I will come to about this particular aspect about the value of exempt supply represented by interest, that is loans, interest on loans. Similarly, if you very carefully see Section 10 subsection 1, the opening part, the preamble part starts with the aggregate turnover. However, once you go down below, A, B, and C clause prescribing the rates, it talks about turnover in a state or turnover in a union territory. While the main part starts with the aggregate turnover, for the purpose of the levy of the tax, for the purpose of the payment of tax and the rates which are prescribed, the section speaks about the turnover in a state or turnover in a union territory. And what it says, supplies from the 1st April, and it now says it shall not be included. Aggregate turnover, it should be included, but for the purpose of payment of tax, supplies from the 1st April in the financial year up to the date of person becoming liable of registration under the Act, that should not be included. So if a person has become liable for registration in the middle of the year, he can also opt for the composition scheme, and his this turnover up to in a state, any such non-taxable or exempt turnover will not be computed for the purpose of 150 lakhs. Similarly, the services by way of extending deposit or loan on which the interest is or discount is charged or paid or payable, that will not be included for the purpose of turnover in a state. This is common for both the purpose. This is very interesting. These are the clauses which have been recently introduced last year. And please carefully study this, both the explanation and the larger implications of this. I have very briefly explained to you on this. The another thing is, if you see the different rates which are prescribed for the under the scheme for manufacturers, restaurant or outdoor caterers and other suppliers. I will not go into the detail. All along for the service provider, ever since the Section 10 and composition scheme came into force, right from 1/7/2017, there has been a continuous claim by the revenue, by the department, by the ministry, and very well accepted by everybody across the country, by taxpayers and tax professionals, that as far as the service providers are concerned, composition scheme is available only for the restaurant and not for any other service providers, including outdoor caterers. With due respect, I have always been holding the view right from the day one that outdoor caterers were and are also covered by the composition scheme. If you read clause section 10(1)(b) very carefully, 10(1)(b) speaks about the supply of services which are described in clause B of para 6 of schedule 2. 6B of para schedule 2, 6.2, that speaks about the supply of food or drink as a part of the service, basically restaurant service and other. This very activity also covers outdoor caterers. There is nothing in para 6B which uses the word restaurant or anything. It only describes the nature of the service which is covered, the activity which is covered. And that description is clear enough to cover restaurant as well as outdoor caterers. And it is this activity which is covered under section 10(1)(b). And therefore, in my opinion, restaurant were not only restaurant, outdoor caterers were also covered by the composition scheme. And today also outdoor caterers are covered by the composition scheme. This is very important for the individual outdoor caterers who have actually, grown up from, like, as we call it in Gujarati, Maharaj or cook. From there, they have slightly expanded into the business once they have gained the acceptance. So, and their turnover sometimes ranges hardly 20 lakhs, 40 lakhs, 50 lakhs, some 1 crore, 1.5 crore. For them to go for the composition, in my opinion, is very, very important. Even the word other suppliers does not mean only traders. This is a serious lacuna and infirmity in this entire provision. Other suppliers cannot be treated as traders only. If they wanted, they should have put it as a traders. Other suppliers can also cover service providers. Because if my subclause B covers only restaurant, for instance, then other suppliers would cover other service providers also, not only traders. There could be some dispute on this. I had wished that this lacuna, if the intention was to restrict the benefit to specific class of persons, it should have been better worded. But so far that, I pointed out this in my discussion, but so far, nothing has been done, but these are my views. Next. Now, with this background and overall aggregate turnover concept, let us now deal with the issues for consideration which arise in this case. Whether the aggregate turnover and or turnover in the state or union territory, whether would include value of exempt supply, then obviously the definition is very clear and it would include exempt supply. The answer is yes. Whether the aggregate turnover or turnover in a state would include the value of non-taxable supply or the turnover of the activities or transaction covered by Schedule 3, I'll come to that in my when I deal with exempt supply. Whether the taxes, etc., leviable under any other law other than GST law would be includable. The answer is yes. Section 15(1), Section 15(2)(b), it is very clear. So any other duties or charges, suppose the property tax is paid in respect of the renting immobile property which has been rented out, please note that there was a specific exemption to property tax under service tax regime. There is no such exemption available in GST. So the tax will be, property tax would not get to be deducted for the purpose of the renting of immobile property service valuation. Whether a registered taxable person will be eligible for the threshold limit 40, 20, 10 lakhs if he has exceeded the limit in the preceding financial year, he will still be eligible. Even if my turnover the registered tax person's turnover has exceeded the specified limit depending upon the location. That's why I have put it three. There are three specific time threshold. He would still be able to claim again the threshold exemption in the new financial year. Here there is an interesting departure from the erstwhile regime. For instance, under Excise Notification 8 by 2003, small scale exemption notification, the overall turnover criteria is 4 crore, eligibility criteria, 4 crore in the preceding financial year, subject to which, if it is not exceeded, the manufacturer would be entitled for the 1.5 crore exemption. If he exceeds 4 crore in the current financial year, whatever 1.5 crore benefit exemption he has availed, that will not be disturbed. But next year, he will not be entitled for the exemption and he will have to pay the tax from the first rupee. Similarly, under 33 by 2012, the service provider ought not to have exceeded 10 lakhs in the preceding financial year. This criteria of preceding financial year has been very interestingly dispensed with in the GST regime. So every year, a registered taxable person subject to other conditions will be entitled to claim the threshold exemption of 40 lakhs or 20 lakhs or 10 lakhs as the case may be. This is another very interesting aspect of this aggregate turnover and the threshold under for the purpose of registration. No, please keep that slide earlier. Whether the small business exemption will be available separately to the co-owners of the property if the rent is collected together and then divided amongst them. This is one issue which would be, I'm expecting that this issue would keep on actually arising even under GST. It should not arise, but it would arise probably. That's why I have decided to include this. Under service tax, it has been a boiling issue for many years that if there are co-owners of the property and the rent is either collected separately and accounted for separately, where suppose the bank has been given the premises are rented out the bank or some other commercial entity or whomsoever, and there are more than one co-owners of that property, either the rent is collected separately in their own name, though there could be a one joint agreement, or the rent is collected jointly combined and then it has been accounted for in the everybody's books as per the share agreed upon for whatever measure. Whether each co-owner of the property will be entitled for the threshold exemption or not, this has been one of the issues in the service tax, and there are umpteen number of judgments on this. And in all those cases, the tribunal has been very consistent in their view that the exemption will be available separately to the co-owners of the property even if the rent is collected jointly and then divided amongst them. Later on, the department actually changed the track and the demands were raised on the ground. Okay, all these co-owners basically signify an association of persons, and because they are AOP, therefore they will not be entitled for the exemption separately of 10 lakhs. Even these arguments were not did not find favor with the tribunal that AOP is an independent concept and they cannot be treated as a AOP also. Some of the service tax judgments on these are Anita Singh versus CCGSE. I'm only giving you latest. There are many, and all these judgments, quite a few other judgments are referred to, but very significant judgments where even AOP aspects has also been discussed are Anita Singh versus CCGST 2018 TIOL 2164, State Delhi, Sarojben Khusalchand 2017 TIOL 2284, State, Sri S. Abdul Haq and others, 2018 TIOL 3852, State Madras, and Srimati Rajeshwari Coimbatore, 2020 TIOL 3283, State Madras. The last one is very interesting, is a quite comprehensive judgment where they have referred to all these aspects. Rajeshwari, Srimati Rajeshwari and others, 2020 TIOL 3283. The issue had also been taken by a very adventurous and enterprising taxpayer to the Advance Authority ruling under GST. And in case of Ilam Branchari Khadum, the AR has followed the service tax ruling also. Same logic, these co-owners of the property would be separately entitled for the exemption. So threshold exemption will be separately available. I normally don't go into the AR judgment. My views on the advanced authority rulings are well known, and but just for the sake of completing the discussion, I am citing few judgments of AR. Otherwise, I don't like to much discuss about the AR judgments. Anyway, there is section 26 of the Income Tax Act, which also says that if the property which is consisting of the land or building by two and it is owned by two or more persons and their shares are definite and ascertainable, then they should not be assessed as association of persons. This could also be, the another argument which can be actually advanced in support of the separate availability of the threshold exemption for the purpose of registration. Likewise, there is a CBDT circular number 715 in which the CBDT has clarified that if there are number of payees and if their share in a property is definite and ascertainable, then the TDS limit, at that time it was 1,20,000, the TDS limit shall apply to each payee, each person separately and not jointly. So these two also further reimposes the, conclusion that it enforces the conclusion that all such co-owners of the property would be separately entitled for the threshold exemption. Another issue arises in the context of the exempt supply and the aggregate turnover is whether a composition taxpayer is liable to pay tax at the prescribed rate in case of wholly exempt supply. Suppose a composition taxpayer has got two streams of supply, either two goods or two separate services or goods or services both. And one of the supply is otherwise wholly exempt under a notification, whether 13 by 2017 or 2 by 2017. 2 by 2017 in respect of the goods, 13 by 2017 in respect, 11 by 2017, 12 by 2017 for services. Now, not 13, I'm sorry, it is reverse charge. So, but he opts for the composition scheme for which is taxable. In that case, will he be required to pay the tax even on the item which is wholly exempt or the service which is wholly exempt? If you read very carefully section 10, and if the aggregate turnover and turnover in a state, if these phrases are very clearly, critically examined, the inference would be that composition taxpayer would be liable to pay the tax at the prescribed rate under composition scheme, even for the wholly exempt supply. Once he goes for the composition, that other exemption available to me under notification will not be available to him. There could be some post for the tax planning in that case. And if the person has a sizable turnover of the exempt supply compared to his other taxable turnover of another item or another service, it might be good idea to actually spin off that exempted activity under a absolutely legal, independent legal entity, so that that exemption continues and only to avail the composition for the limited purpose. I mean, this would all depend upon the facts of the case. Next. Coming to the taxable supply, exempt supply and non-taxable supply. Taxable supply of goods or services or both, which are leviable to tax under the Act. Here the word leviable is very, very interesting and important. What is the meaning of the word leviable? Black's Law Dictionary and even the Advanced Law Lexicon by the P. Ramanta Iyer. I mean, these are all obviously the Bhagavad Gita of the lexicology. So it defines in the same manner, leviable means that which may be levied, that which is proper or permissible subject for levy as a leviable interest in a land. So which is permissible subject for levy. Exempt supply includes, as per section 2 subsection 47, supply of any goods or services or both attracting nil rate of tax. So there are many items, particularly in the context of goods, where the tariff rate itself is nil. The item is otherwise covered within the scope of GST, but the tariff rate has been prescribed as a nil. It will be treated as an exempt supply. Supply of any goods or services which are wholly exempt under notification under section 11 and corresponding section 6 of the IGST Act. So section 11, this is a very poor language because section 11 does not exempt Section 11 empowers the central government to issue the notification on the recommendations of the council for providing for the exemption. It itself does not exempt. Section 11 does not directly exempt anything. Very poor language, but anyway, we have to go by the spirit of the thing. I hope they will correct this also. So if there is a whole total, but mark the word wholly exempt. If there is a partial exemption, it means that there is a concessional rate which is provided. If the tariff rate is 12% or say 18%, if 18% it is actually prescribed as a concessional rate by 5% or 12% is prescribed as a 5% with or without condition, these are not wholly exempt from tax. These are partially exempt from the tax. So then they will not come within the scope of exempt supply. Non-taxable supply. Non-taxable supply, as we have already seen under Section 22, Section 78, on which tax is not leviable under this Act, that is CGST Act. Next. With these concepts, the major issue, please next slide, please. Next slide. Non-taxable supply, which is not leviable to tax. Similarly, zero-rated supply, before I come to non-taxable, zero-rated supply is defined under Section 16 of the IGST Act. What is the difference between zero-rated supply and exempt supply? Because in either case, the tax is not payable. One is in relation to exports, another is in relation to the domestic supplies. The important thing is, in case of zero-rated supply, the supplier, the taxable person's right to avail the ITC is not taken away. Though he does not pay the tax, he is still given the benefit of ITC. One may refer to Section 16, subsection 2 for this purpose of the IGST Act. It makes it very clear. Whereas in case of exempt supply, the immediate and the lasting impact will be on the taxpayer's entitlement to the ITC, because then he will be hit by Section 17(3) and he will lose the proportionate benefit of ITC, or he may lose the entire benefit of ITC. And therefore, exemption breaks the chain of the ITC. Zero-rated supplies maintains the chain of the ITC, even though in both the cases the tax is not paid. There are other differences, but I'm only pointing out the fundamental differences. This is very important because the concept of zero-rated supply, in a way, basically embodies the destination-based character of the VAT and also the value-added feature of the GST. This value addition, taxing only the value addition, is achieved under VAT or GST by providing for the credit of the tax paid on the inward supplies to be utilized for the payment of the tax on the outer supply, output supplies. Similarly, destination-based principle requires that if the taxing jurisdiction is outside the country, say India, then no tax shall be levied. If the place of supply is within India, then only the tax shall be levied. Therefore, imports all over the world under VAT or GST, imports are subjected to tax, services under reverse charge, goods are obviously at the port, and the exports are totally relieved or are attempted to be relieved of the taxation burden. This is destination principle. And here, the zero-rated supply, by providing or maintaining the ITC chain, also maintains the character of the value-added tax. And thereby, the exporters are relieved of the burden of the taxes. Because while international adage that while exporting the goods or services, the domestic taxes should not be allowed to be exported by the exporter because it will render him internationally uncompetitive. These are all embodied in this zero-rated concept. And on the sideline, therefore, the more the exemption, more are the distortions created under VAT or GST. Basically, in an ideal GST or VAT system, there should be bare minimum good supplies, which should be whether goods or services, which should be outside the tax net. Bare minimum. New Zealand is the best example of that, followed by Singapore. Because the exemption breaks the chain of the ITC. There is a very famous, words by the internet, one of the German international expert who is German, and would be difficult for me to pronounce his name. But he has actually captured the essence of the VAT system in only few words when he says that VAT is a paradox. Operating through the tax credit invoice credit system, it is a system in which one who considers himself as taxed is exempted, and one who considers himself exempted is taxed. If you have understood this paradox, you have understood the VAT. Because a person who is exempted is in any case paying the taxes on his inward supplies, of which he does not get the credit. So indirectly he pays the taxes. Person who is paying the tax is in any case getting the benefit of the ITC. So effectively he pays the tax on the value addition. This is basically the essence of the entire VAT system. Okay, so this concept should be kept in mind, the distinction between zero rated and exempted. Coming to the non-taxable supply, the word are leviable to tax. It is not levied or it is leviable. We have seen the leviable meaning as per the law lexicon and the Black's Law dictionary, that a permissible subject for the levy. In this context, let us see whether Schedule 3 would come within the exempt supply or not. What is Schedule 3 to the CGST Act? It says activities or transactions which are not to be considered either as a supply of goods or supply of services. That is what Schedule 3 says, and it lists out all the entries. The question here is, if a particular activity or transaction is openly declared, legislatively declared as neither supply of goods nor supply of services, will it come within the scope of the supply at all? Can it be levied to supply at all? It cannot be leviable to supply. I'll give you one very clear example. I beg your pardon. Entry 5, sale of land and sale of building, other than the under construction building, which is at 3. Now, what would have happened? Suppose these two items have been kept out of the Schedule 3. There was a very, very unfounded apprehension expressed by everybody in the beginning when the law was on the model stage, and then thereafter, that because services is defined as a services means anything other than goods. So if the immobile property is not kept within the scope of is not kept out, then it will get taxed under services. This was an absolutely unfounded, unjustified, and overreaction to the overall scheme of the thing. Land and building being the immobile property remains outside the purview of the union's powers. If you see the constitutional framework, Article 46A, read with Article 366(12)A, which defines the goods and services tax, it clearly speaks about the supply of goods or services, tax on the supply of goods or services, law relating to supply of goods or services or both. The very constitutional framework which has been actually laid down through the 101st Amendment Act, Constitutional 101st Amendment Act 2016, that constitutional framework does not contemplate nor does it allow the immobile property to be brought within the purview of the GST at all. That was not even the scheme of the thing. And not recently, the overriding powers given under Article 246A, which overrides Article 246 and Article 254. Article 246 is basically the demarcation of taxation powers between union and state. 7th schedule, union list 1, state list 2, and the concurrent list. I'm not going too much detail into it. Even that overriding power would come into play of Article 246A, which deals with GST laws, would come into play only in respect of the subject, a particular subject which is otherwise covered within the scope of the GST laws. If a subject itself is not covered within the scope of GST law, that overriding nature of Article 246A cannot bring it within the scope of the law, meaning here immobile property. And therefore, in my opinion, this entire apprehension, which was unnecessarily voiced in the beginning, maybe because of that, the land and building have been kept out, but it has led to lot of issues, and it has ultimately hit the taxpayers rather than benefiting the taxpayers. So with this, if leviable, the question of leviability arises only if the particular subject, it is permissible to tax. In other words, you exclude something only if it is otherwise includable. If something is not includable, the question of excluding it does not arise at all. If you look at it from this perspective, one, the certain entries like high sea sale, or for that matter, the supply of the goods from one country, one foreign country to another foreign country, by an Indian importer exporter. He buys the goods from Japan and have it directly shipped to USA or any other country without bringing the goods within the Indian territory. If the goods do not enter the Indian customs, where is the question of levy of any tax on it? And how can there be a GST liability on it? There was no need to approach the advance authority ruling for this purpose at all. Fortunately, now the entries have been inserted. This does not require the inclusion of the entry in Schedule 3. Because it has been inserted, the past cases which have been made by the department, in my opinion, legal position was clear. These were never coming within the scope of the taxation. One, in any case, the entry inserted 7 and 8, which inserted in Schedule 3, are purely clarificatory in nature, and therefore, because this was the legal position always, and this inclusion makes it very clear that they don't come within the scope of the supply. And therefore, the activities or transactions specified in Schedule 3, in my opinion, will not come within the scope of exempt supply. Coming to exempt supply, whether it will include the value of alcoholic beverages for human consumption, again, alcoholic beverages is constitutionally outside the purview of the GST law, therefore it will not include, cannot include within the scope of non-taxable supply, and therefore it cannot come under exempt supply via non-taxable supply. Similar is the position for petro products. The 5 petro products which have been kept out of the GST, please understand, by prima facie reading, they are not like alcoholic beverages for human consumption, they are not kept out of. But if you see Article 279, clause 5, only council can recommend from which by which date through notification these 5 products would be brought within the scope of the levy. Today, there is not even a notification providing for the tariff rate nil for these 5 petro products. They are neither exempt supply nor taxable supply. They are into Trishanku-like position. They are into no man's land. These 5 products are into no man's land. They cannot come within the scope of the supply under GST. Therefore, they cannot come within the scope of non-taxable supply or exempt supply at all. So, because there is no rate, there is not even a tariff rate nil for these 5 products. Okay? So, nothing is leviable unless, next. Similarly, electrical energy. Electrical energy has been considered as goods. There are judicial ruling on this. It is, you will find the entry in article tariff heading 27, sketch 16, 2716, chapter 27, 0000. Very surprisingly, you will not find any tariff rate for the electrical energy, not even nil. Tariff rate may mention nil, but that nil tariff rate is prescribed by notification 2 by 2017, serial number 104. But for that notification, there is no tariff rate prescribed for the electrical energy. Unit is prescribed as a 1000 kWh. The larger question which arises is, if there is no tariff rate prescribed for the electrical energy, where is the question of exempting by the notification? Can it be exempted if there is no tariff rate? Either there can be a tariff rate nil, or there can be a tariff rate 2.5% or 6% or 9% or 14% under the tariff. If none of these 5 tariff rates are available at all, not prescribed at all, where is the question of exempting it by a notification? There is some serious lapse here. This can become a very interesting in future. Again, I'm not going into details into this, but please keep this in mind. This is something which can become a matter of huge dispute income sometimes. Coming to the interest on loans, advances, or deposit, in this 2AR ruling, the advance authority has held it to be includable for the purpose of aggregate turnover. In my opinion, there is a complete misnomer and misunderstanding over here. What is the services? If you see at entry 27, which has 2 clauses, A and B, entry 27 of notification 12 by 2017 it actually exempts services by way of a lending of deposits, loans, or advances where the consideration is represented by the interest or discount. What is being exempted? Whether, first of all, whether interest is a supply or whether interest is a consideration. Interest obviously is a consideration that itself is actually accepted in the entry itself, exemption entry itself. So that consideration is being exempted. Basically, this is the abatement, value abatement from value notification. Because they have continued with the erstwhile philosophy of service tax, this confusion problem is going to arise. Now, and what is being exempted? Only services can be, supply of services or supply of goods can only be exempted. And what supply of services is contemplated here? Lending services by way of a lending of deposit. The question which arises here, whether the lending by way of advances, loans, or deposits, can it be considered as a supply for the purposes of GST at all? Does it come within the scope of taxable supply? Isn't it a transaction in money? Please understand, under the banking and other financial services in the erstwhile service tax regime, what was being taxed was services in relation to lending, not lending per se. Isn't the lending of loans by the bank or a person to one entity to another entity, isn't it a transaction in money? If it is transaction in money, it goes outside the purview of the GST altogether. Then where is the question of exempting it or any consideration in relation to it? This is something which I'm not going into data. I'm just posing such posers. My personal view, my prima facie view would be that this entire entry relating to interest on loan is absolutely misnomer. It is an invalid entry. And because of that, treating it as an exempt supply, if it is to be included for the purpose of aggregate turnover, a serious validity and maintainability challenge lies to it. The other part about the last part on this is, if you see, I was talking about Schedule 3 activities which are not, which cannot be considered as a non-taxable supply. Therefore, it will not come within the scope of the exempt supply. If you very carefully see Section 17(3), it clearly says that for determining the value of exempt supply for the proportionate entitlement to the ITC, the value in relation to sale of building, sale of land, building other than under construction, sale of land, and transactions in securities should be included. If sale of building and sale of land, otherwise covered by Schedule 3, if they were already covered within the scope of the exempt supply definition via non-taxable supply, then where was the need for the deeming fiction under Section 17(3)? This deeming fiction further enforces the view that the interest on loan, this Chapter 3 activity cannot come within the scope of the supply, non-taxable supply. Next. Coming to the liquidated damages, forfeiture of deposit and penal interest. The next. Friends, this particular topic will revolve around the entry 5E. Please come to next slide. Entry 5E of Schedule 2, supply of service. The following shall be treated as supply of services, namely agreeing to the obligation to refrain from an act or to tolerate an act or situation or to do an act. This is of late has become an extremely hot issue. And just for the consolation, this is not in the context of only Indian GST. This issue has been always boiling, and it is now going to go further, even under the international VAT jurisdictions. Next. This is a frequently arise. This issue has always frequently arisen, and the genesis obviously lies in that entry regarding the obligation to do an act or to tolerate an act. And basically, the overall intention was to cover the non-compete agreements or certain specific cases, but its scope is getting now widened day by day. And there are obviously, as usual, controversial rulings of the advance authority on these issues as well. Next. If you come to the service tax regime, prior to pre-negative list regime, before 2012, this controversy had never arisen because there was no enabling entry like to tolerate an airport situation, etc., etc. It came to be defined as a deemed service under Section 66E by Clause E. And from there, the disputes have arisen. Prior to 2012, this entry was not there. In one of the, the recent cases of Amit Metallics Limited, I will refer to that judgment in a while. In Amit Metallics Limited, this aspect was taken note of, where there was a similar issue had arisen about the levy of service tax on the compensation received by the party. The tribunal took note of the fact that the agreement had already been entered into prior to the 2012, before declared service came into force, and therefore this liability cannot arise, though they have also gone into the merits of the case later on. I'll come to that. Next. The judicial view have been very consistent, fortunately, in the Indian context in service tax. In Jupiter, basically this is a Jaipur jewelry, so I beg your pardon. In Jaipur jewelry, so it was a case of the cancellation of a booth which was actually organized in an exhibition, and whatever amount was received in advance, that amount was refunded, and the issue arose because initially the amount had been kept. The tribunal held that when amount was refunded and no booth was rented out, there was no consideration received by for the services. And this was in the nature of, initially when it was received, it was in the nature of advances. And because the services were never provided, it cannot be taxed under the business exhibition services. In Amit Metallics, not metals, Amit Metallics case, there was a termination of a development agreement between the parties by the client, customer, and who were also paid the certain amount under the settlement agreement. This compensation was sought to be levied to the tax by the department under the declared service entry because the cancellation happened post a negative list. In a very detailed judgment by the tribunal, where they have gone into the first aspect, the agreement was prior to 2012, so even then also the liability cannot arise. But on the very merits of the case, the tribunal said that this compensation has nothing to, it cannot be set toward provision of any services. It cannot be treated as a service at all, and therefore no tax liability will get attracted into this. One important observation has been made by tribunal in this, and that is that this compensation received by the party is more in the nature of actionable claim, as laid down in Kesoram, AIR 1966 Supreme Court 1370, and Sunrise, that is lottery case, 2006 5 SCC 603. These particular observations of the tribunal, these are more in the nature of actionable claim that can create some problems. Please bear it in mind. All this judgment, I would enjoin upon the participants, please do read all these judgments. These are very important judgments. Because under GST regime, actionable claim other than, they are all exempted other than lottery gambling, as we have seen horse trading. So if exempted, if this is an actionable claim, and if this gets exempted, because it is under Schedule 3, and if department takes the view that this is a non-taxable supply, therefore it will come under exempt supply, there could be some issues which are we might be arising. And whether this can be treated as an actionable claim or not, that itself is probably may have to be further closely examined. In KN Foods Industries Limited, a job worker was given the compensation or ex gratia job charges because the principal had not been able, had given him a lesser work than what was actually contractually agreed upon. And for this lesser work, he was given the ex gratia job charges. Again, department had raised the service tax demand on this, and in KN Food case, the tribunal said it is not liable for the tax. Similarly, one of the most important judgment on this is the Repco Home Finance Limited case. This Repco Home Finance, this is a larger bench decision very recently given. I again, suggest to the participants, please go through this judgment very minutely. In this, the issue involved was regarding the damages for the foreclosure of loan. And this foreclosure of loan was sought to be taxed as a service tax by the department. The tribunal, in a very detailed judgment, made certain very important observations. Well, like in para 39, the tribunal said, this is a larger bench decision, that the whatever damages are received for the foreclosure of loan, the clause pertaining to that is inserted in the contract to bring about the certainty in the contract. It does not give rise to a consideration. So therefore, if a particular contract speaks about the damages to be awarded to the victim, to the party on account of the breach of the contract by other party, then it itself does not give rise to any consideration. It only means that there has to be, it brings a certainty a contract will be performed. Here, what is the contract certainty which was expected from the banks? That the loan will be continued for a particular tenure. If it is then foreclosed, then to that extent bank suffers. And therefore it cannot be treated as this clause cannot give rise to any consideration. Another observation made by the tribunal in para 44 of the judgment is that this is recovered for the disruption of a service and not toward the lending services. The liability of service tax is in respect of the services provided in relation to the lending. By foreclosing, actually, I am now closing down my loan. So there is a disruption of the service rather than there is a opening of the service. And foreclosure, in fact, the foreclosure, as tribunal noted, foreclosure is an antithesis to lending. Further observation made in para 46 that by such clauses, the one party is not giving an option to another party to violate the law, violate the contracts. I beg your pardon. It does not give an option to perform or to not perform or to violate the contract. To put it other way around, if there is a performance is the essence or the time is the essence of the contract, a standard commercial terms which are used in the contract or agreement, then in that case, and for which if any damages are to be awarded, liquidated damages or for by any other name clause, no two parties enter into the contract to violate the contract. I'll repeat, two parties cannot be said to have entered into the contract so that one party will violate the contract, which would entail the damages to be paid by him to the other party. This interpretation is absurd. And another important point to be kept in mind is every agreement, contractual arrangement, commercial arrangement includes the do's and don'ts by either parties. One party is obligated to do something, correspondingly, other party is also obligated to do something. And in the event failure of one to do that, another party gets the damages. These such do's and don'ts or each and every terms or contract of the contract or the covenant of the contract by itself does not constitute an independent contract. The contract is main contract. Such each and every term of the contract does not constitute an independent contract. Therefore, it cannot be brought within the scope of the independent supply, nor can it be considered or treated as so. So in all these judgment, the no tax, verdict in the service tax regime has been fairly consistent. Next. However, under GST, if you compare entry 5E of Schedule 2, it is identically worded as the erstwhile entry E of the Section 66E of the Finance Act 1994. And the opening words are Section 7. The opening words of entry 5 are the following should be treated as supply of service. And under entry 5, there are various entries which are basically replica of the declared service, erstwhile declared services. And under Section 7, Clause D was actually omitted retrospectively. And what was the Clause D? The activities to be treated as supply. As you know, friends, supply definition is an inclusive definition. Section 7.1 says supply include ... Then scroll down and Clause D comes. Supply, how it would have read? Supply includes the activities to be treated as supply of goods or supply of services referred to in Schedule 2. These particular lacuna in the language and very absurdly worded provision has given rise that Schedule 2 is a deeming provision. Almost everybody in the country had been saying that the Schedule 2 is a deeming provision because it is covered under the inclusive part of the main definition, Section 7.1. The advanced authority rulings have also gone on the same footing because obligation to do an act or tolerate an act is covered within the scope of entry 5, which is part of Schedule 2, which is covered within the scope of supply. Therefore, there is a deeming. Schedule 2 was never a deeming provision. Schedule 2 was always a categorization provision, whether supply of goods or supply of service. It was never a deeming provision. There was a fundamental misunderstanding and misconception prevalent all around. Fortunately, the legislature saw through it, and the board also was quick to actually see what damage it is causing, and therefore very significantly, section clause D was omitted, replaced by clause 1A, capital A, which now says if any activity or transaction is a supply, then it should be categorized, treated as supply of goods or supply of service as per Schedule 2. So first, there should be a supply. That supply should merit the requirements of Section 7(1), which are the two requirements in the course or furtherance of business and for a consideration. These are the basic requirements. Once these two requirements are fulfilled, then only it becomes taxable supply prime unless it is dispensed with. And then only one has to see, if required, in a given case, whether I should treat it as a supply of goods or supply of service. Secondly, the word treated cannot be equated with deemed. It does not say the activities to be deemed as supply. It says treated. Even entry 5 also uses the word treated and not deemed. Following should be deemed as supply. These are not the words. So Schedule 2 was never a deeming provision, is also not a deeming provision, never intended to be a deeming provision. Next. Next. Next, please. In all these judgments, if you will find that the AR has gone into the same basis that in like Maharashtra State Power Generation, there was a liquidated damages for the delayed in the performance of the contract. Advance Authority, Appellate or Advance Authority ruling appealed the judgment on merit, but only said that if the contractee, that is the client is required, Mahagenco is required to pay the GST because of on the contractor which is charged. So then in that case, the appellant will be entitled for the ITC. Javer Sankarlal Bhanusali is the case of compensation awarded for the purpose of the surrender of the tenancy rights. Bajaj Finance Limited is a case of penal interest, appealed in the AAR. North American Coal Corporation, it was a award of the settlement, the award by the International Arbitral Tribunal, International Chamber of Commerce, in respect of the contract which was on which the other party relegated. So this is the latest case. Dholera Industrial City Development, I will give the citation later on. Dholera Industrial City Development is again a case of the liquidated damages. Rashtriya Ispat Nigam Limited is again a case of the similar type of compensation. These are all the rulings in which the Advance Authority ruling has only gone by treating practically or directly or impliedly taking Schedule 2 Entry 5E as a deeming provision and then holding it liable, compensation or liquidated damages liable to tax. Next. 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 Previous one. The one aspect of this is that, as I said, business and consideration are two essential pre-requirements for the supply to become a taxable, unless it is dispensed with. In clause A, clause B, it is dispensed with. The business criteria has been dispensed with for the import of services, if it is for a consideration, whether or not in the course of furtherance of business. Clause C, it has been dispensed with for the Schedule 1. Even if there is no consideration, it will be deemed to be a supply. Schedule 1 definitely is a deeming provision. If we treat Schedule 2 as a deeming provision, it is a deeming fiction, then a very anomalous and absurd situation will arise. Even if there is no business element or even if there is no consideration, still all the activities mentioned in Schedule 2 will become taxable. Can this be the interpretation? In my humble submission, no. Next. Next. Next, please. Next slide, please. The previous one, please. Previous slide. Yeah. Coming to, no, next slide, please. Please just slightly be alert, please. we are running against time. This particular issue needs to be looked into from the international weight perspective also. One of the important, there are quite a few latest development. I will very quickly take you through all this. One is weight on retention of deposit money by hotel on account of cancellation of the booking. And in Société Thermal case, this is a company based in France. The European Court of Justice decided the tax liability does not arise for more than one reason. One, the missing direct nexus between the consideration and the supply. It cannot be treated also for consideration of any service provided. It only ensures the performance. And if the client choose not to avail the facility, it cannot be treated as liable to tax for the cancellation purpose if the whatever money is retained by the hotel. However, in Air France case, European Court of Justice took a completely departure from this practice. And in Air France case, there were two issues. One is regarding the no-show by the passengers and who had not claimed the refund, or no-show by the passengers on a ticket which was not refundable at all. Now, in both the cases, the GST or the VAT authorities had demanded the tax under European Union Community Law. And in this case, the European Court of Justice said, held the, I'm not now going into the observations, but they have upheld the levy of the VAT on such amounts retained by the airline on the unused air ticket. Similar view has been taken by the Australian High Court in the Qantas Airways Limited. This is also a very significant dispute where the forfeiture of deposit in case of on the airline unused ticket only, Qantas and Jetways Jetstar Limited. This is a combined case. Up to full federal court, the decision had gone in favor of the party on the company. However, the High Court of Australia reversed this decision, and they have held more or less on the same line as European Court of Justice has held in Air France. Again, GST on the forfeiture of deposit in case of sale of real estate subsequent to the rescission of the contract upon default. Up to federal court in Reliance Carpet Company Pty Limited, the federal court had held in favor of the company. This decision was also reversed by the High Court of Australia, and VAT was held to be applicable. Again, VAT treatment of early termination. These are the two latest decisions. One is the MEO, Services de Comunicações of Multimedia, which is popularly known as a MEO case, and followed in Vodafone Portugal case, which is the latest one on 11 June 2020. In both these cases, both the telecom operators had provided certain services subject to, at a very low price, subject to certain commitment period or the minimum pay period. And if the customers opt out of the services before that commitment period, expiry of the commitment period, certain compensation, the charges or damages were retained by the company. These are detailed judgment. And in both these significant judgment, the European Court of Justice have held that the VAT is applicable on such damage or compensation awarded by retained by the companies. And they have actually distinguished MEO is not a very speaking order. These happens even in the international court also, not only in India, but at least Vodafone Portugal is a very speaking order, and they have not gone by the Société Thermal case, which had held a field for many years. Similarly, in a Qantas Airways case, the argument of the soul and essence of the contract have not been found favor by the High Court of Australia. Based on the Vodafone and the MEO case, the Revenue and Custom Brief, the HMRC, Her Majesties of the Revenue and Customs, HMRC, which is somewhat equivalent to our Central Board of Indirect Taxes and Customs, they have actually revised their guideline on 2nd September 2020. These revised guidelines practically takes into account what has been held in the Qantas and the MEO and Vodafone case and seeks to levy the VAT on the consideration by treating the compensation or damages as a consideration. We may therefore say these are all based on the facts of each case. These are what I am trying to explain to you, friends, is that each of these cases will have to be taken on its own merit, whether in the Indian context or in the otherwise. And one has to see whether these are how far the facts will fit the Indian context. Whether a damages, the moot question is can the damages or compensation awarded to a party on account of the breach of contract by another party be considered to be a supply by itself, and whether the presence of this clause in the contract would create any taxability or chargeability in the event that damages is ultimately awarded. These are the moot track. In the High Court of Australia has gone by that the moment a person enters into that contract, it creates the right. Whether that right is exercised is not, that is not important, because that the right is created, and therefore for that, if there is any breach later on follows, whether customer avails that right, like a no-show in the by the air passenger, still the service is deemed to have been provided the moment the contract is entered into, and therefore the tax is payable. So these are the certain interesting issues which are going to come up in the coming days. One may have to be very, very careful in understanding the facts and laying down the principle. Next. Another important, interesting ruling is, again in the Australian, New Zealand case, is the Interchase Corporation Limited, where there was a judgment cost which was awarded to the judgment creditor through the court, whether will it actually be a supply or not. And these are the, in this case of case 577, 1996, this Interchase Corporation Limited was relied upon. And very interesting observation, this was the case of So versus Director of Housing. A taxable, again, another case of Tasmania. A taxable supply is made if the supply is made for consideration. This is new GST Act 1995 of Australian GST, which is equivalent to our CGST Act. Here it is known as the new GST Act 1995. A taxable supply is made if the supply is made for consideration. Consideration includes matters done pursuant to order of a court, but that does not itself constitute a supply. The receipt of payment by a judgment creditor does not obviously involve the creation, grant, transfer, assignment, or surrender of any right, or the entry or release from an obligation. When the judgment is satisfied, the debt created by the judgment is thereby extinguished and does not depend on the surrender of any right or the release of the judgment debtor. Very important observation, which may become handy in the context of the compensation or arbitration awarded or any such damages awarded by the arbitral tribunal or the court. We will have to see this in the coming days. Next. So friend, to conclude on the liquidated damages, my personal view is whether foreclosure charges, penal interest, liquidated damages, or the cancellation forfeiture of the deposit in case of any show cancellation, or customer not turning up, viewer not, like a ballet dance or the musical show. In all these cases, it is in the Indian context, it is possible to argue, particularly when that particular clause relating to obligation to do an act has not been put in as a deeming provision. Unlike under service tax, it was declared as a service. There is no such. This is the difference between the declared service concept and entry 5 of the Schedule 2. Declared service was actually a deeming provision, whereas Schedule 2 is not. Therefore, entry 5 of Schedule 2 is not. And therefore, it is possible to argue that such liquidated, receipt of such liquidated damages, etc., by itself does not and cannot constitute a supply, and therefore it is not liable to tax. Next. Now comes another hot topic, and that is the buyer's ineligibility to take the ITC when the supplier does not pay the tax. We are all aware about the provision, so I will not go through that. This is one of the conditions which has been inserted in the CGST Act under the GST regime. Friends, you are all aware that under excise for almost 7 decades and for service tax, this such condition was never inserted. And the entitlement of the manufacturer or service provider to the moderate credit or sandwich credit was never made dependent upon whether the supplier is paying the tax or not, or supplier is paying the excise duty or not. For the first time, it has been inserted in GST regime, mainly at the insistence, as I see, mainly at the insistence of the state authorities, because the states were hell-bent upon to have such condition, particularly after that major controversy surrounding the Mahalakshmi case of Bombay High Court, which happened in state of Maharashtra, which went right up to Supreme Court. And thereafter, every state wet law act had introduced this type of provision, which had become the subject matter of the discussion and dispute before almost each and every high court in the country. But because states were adamant about inclusions of such conditions, this has found place in the eligibility criteria under Section 16. Now, let us see what is the validity and maintainability of this. Next. 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 Oh, okay, please. Next, previous one. Yeah. So, previous one. No, the next one. Next one. Slide number 31. Yes. So, non-fulfillment of the condition would basically, and in this COVID pandemic, which has not left the country so far, and though it might be on the wane, but not one should be on the guard. Unfortunately, and I hope I will be proved wrong, COVID-19 is not going to go away so soon. So it is better to be alert on every front, not to take any chance, because even if one doesn't take chance, there is no guarantee. So there is no question of taking any chance for as far as the COVID is concerned. But in this COVID-19 era, such type of non-payment by the supplier, I'm not talking about the fraud. I'll come to the fraud part later on. But if genuinely a supplier facing the liquidity or the financial crisis has not been able to pay the tax, the recipient registered taxpayer is bound to lose the credit. And such cases may come to the surface now in the coming years. Please, those who are doing the review or audit may have to be very careful on this particular aspect while finalizing their 9 and 9C. Because more and more cases of the default or bankruptcy would be there. And therefore, the recipient taxpayer who might be your client may tend to face the ineligibility, hanging sword to the ITC. Similarly, when the vendor fails to pay, then large businesses, particularly MSME sector, who are supplier to large businesses, the large businesses would tend to lose the ITC. And failure of the registered taxpayer to pay the tax due to liquidity problem, closure of unit, as I said, there could be many reasons. So I'm expecting that acute pain both ways, legal dispute and even at the financial crunch, these are going to be felt in the coming days once some normalcy returns and the actual audit, etc., starts or the scrutiny starts. Scrutiny not from income tax purpose. There is nothing like income scrutiny concept under GST as is understood under income tax. Just to clarify that. Next. The issue is whether this condition can be considered to be, but not only just and proper, whether valid and maintainable at all. A similar condition has been held to be unconstitutional and has been forced by a series of judgments by the High Court in series of judgments, totally. And these are even today also, the judgments keep on coming, and there are quite a few. The recent cases are also of the in the Arise India Limited also Supreme Court judgment. Then Altaf Sus, where they have actually held, they have referred to the Altaf Sus of Madras High Court. Then Supreme Court in another Arise India, that is Tax Sutra 2 SC, Supreme Court 2018. Then Punjab Haryana, the Gerulal Balchand case. Then again, Honorable High Court of Delhi, it was a Arise India case. Then High Court in Raman and Company, Vinayaka agencies, which I have cited, Britannia Industries case, 2016 TIOL 489 Madras. So these are the judgments which have actually held that for the fault or any default or misdeeds of the supplier, the buyer cannot be denied the credit. This is the consistent view by the High Court. In fact, in Punjab Haryana High Court, in Gerulal Balchand has very clearly said also, the law cannot put such onerous responsibility on the SSE, otherwise it would be difficult to hold the law to be valid on the touchstone of Article 14 or 19 of the Constitution. A statute has to be read in such a manner so as to do justice to the parties. If it is held that the person who does not deposit or is required to the tax would be put in an advantageous position, and whereas the person who has paid the tax would be worse, the interpretation would give result to an absurdity. To conclude, Punjab Haryana High Court in Gerulal Palchand case. To conclude, no liability can be fastened on the purchasing registered dealer on account of non-payment of tax by the selling registered dealer in the treasury unless it is fraudulent or collusion or connivance with the registered selling dealer or its predecessor with the purchasing registered dealer is established. Almost the same view has been expressed by the High Courts time and again, that unless and until the complicity or the connivance or the involvement of the recipient purchasing dealer, taxable person, is established in any such misdeed of the supplier, merely because the supplier has not paid the tax or he is untraceable, the buyer cannot be denied the benefit of the credit. And in fact, friends, this European Court of Justice, these two cases which I have cited, there are quite a few. These two group of cases also echoes the same view. And this has remained a good law even today. And the sum and substance of the European Court of Justice judgments are that unless and until the involvement or the complicity of the buyer or the recipient purchaser is established in the fraud being committed by the supplier, merely because the supplier has vanished or supplier has committed some fraud or supplier has not paid the tax, the buyer cannot be denied the credit. In my humble opinion, it would be probably difficult to foresee whether this clause section 16(2)(c) would be upheld by the High Court. There are already some challenges have already made in Delhi High Court and Kolkata High Court, and maybe in the offing in other high courts as well. So it would be very much, quite interesting if the High Court upholds. In my personal opinion, these are all the language may be different, but the substance is what? If the supplier does not pay, buyer will not get the credit. Can this difficult? And law, there is one of the established principles of law is law cannot compel somebody to do the impossible. If a bona fide buyer in the normal course of business has obtained taxable supplies from a supplier and also accounted for it improperly, paid the supplier also, including the entire invoice value, and if the supplier vanishes, can the buyer be denied the ITC? Can the buyer be expected to ensure that the supplier pays the tax? In my humble opinion, this is an onerous and impossible burden which cannot be cast upon because the law does not compel somebody to do the impossible. And therefore, it would be difficult to see how this provision could be upheld by the High Court. And European Court of Justice have also been very clear. Unfortunately, GST is a very, very fraud-prone tax. VAT or GST is a fraud-prone tax. Operating through the invoice credit mechanism, the frauds are bound to happen. And because invoice is the only major document, it is a sacrosanct document, it opens up a lot of floodgate for the opportunities for the fraud. And friends, you know that in our country, invoice is probably the largest selling commodity. So therefore, more and more cases which are coming to the light are all revolving around bogus invoices and the fraudulent credit. And this is the problem not only here, arousal fraud, bogus refund, vanishing dealers, non-reporting of the sales. These are the standard problems which are being faced at the international level by almost every country. The self-enforcing character of the VAT is always under debate and dispute because there was a presumption that because the credit is available, a taxable person would not be inclined. A taxable person would not be inclined to actually evade the taxes. That is the presumption, which is not a correct presumption, which is now getting, and this is being noticed now. Anyway, so the question here is, all the countries are facing these problems. Frauds are actually achieving the menacing proportion in India. What is the thing to worry about is these frauds are becoming all over the world. The money which is generated through these frauds are getting diverted into drug trafficking, terror activities, and the Hawala scam. It may not be, a good sign, and one should be on the guard, either getting involved into this one way or another, or endorsing such or assisting in any manner. We are going to see some very, very tough and difficult days ahead. Having said that, merely because supplier commits the fraud, And if the buyer is no way connected with that, he is also actually a genuine victim of that, then he cannot be denied the credit. So we will have to see some ways. This is my view also. And this earlier High Court view in the context of weight, I feel that the ratio completely applies to the GST also. Next. Coming to section 16.4, time limit. Next. Section 16.4 speaks about the time limit for availing the ITC. And it says, a registered person shall not be entitled to take ITC in respect of any invoice or debit note for supply of goods or services or both after the due date of furnishing of the return under section 39 for the month of September following the next financial year or furnishing of the relevant annual return, whichever is earlier. So basically, two alternate dates are prescribed. Either the due date for the filing of the return for the September of the next financial year, or the date of due date for the relevant annual return, whichever is earlier. Put it simply, for 1920, the due date for filing the September was 20 October 2020 for last year. So any invoice or debit note related to this, the period has actually expired on 20 October. This is the common understanding, right? Whichever is earlier. The question here is whether this time limit, what is the validity of the time limit, whether this time limit applies at all or not. Let us see that. Next. One of the conditions, if you see, for availing the ITC is subject to time limit. On the sideline, let me say, earlier excise and service tax, at least excise never had the time limit for taking the ITC. Under sub-rule 7 of rule 4 of service tax rules only, Senate credit rule, the time limit was prescribed for some period. Otherwise, this time limit issue was never there. The question here is, the time limit which are prescribed are two alternate, because we have to decide two time limit. One, the due date for furnishing the return for the September of the next financial year under section 39, or the due date for furnishing the annual return. Obviously, due date for furnishing annual return is very not difficult because it is a fixed determinative date. There is no issue about that. Section 39 requires GSTR 1 to be filed. And if you see carefully the history, I'm not going into the technical part. I've listed all the amendment made to this. You know that GSTR section 39, GSTR 3. This GSTR 3 is right now under suspension. And 2 and 3 are not operative at all. 3 is replaced by 3B. This 3B was originally treated to be a temporary arrangement, but not in lieu of 3. In fact, after 21 days only, in initial law, CGST rule, Rule 61, spoke about the 3B in lieu of 3. But after 21 days only, the GST Council proposed the amendment and the word in lieu of were removed, omitted from that. So it was never actually expected to take place of 3. In Appen Company, Gujarat High Court has taken note of the 3B purpose and scope and what is the binding effect. And they said that the 3B is not in lieu of 3 for the purpose of section 39. No doubt, the judgment is under challenge before the Supreme Court. Meanwhile, very recently, last year in 2019, October, finally on the basis of the recommendation of the council, which is a common phrase, central government has modified Rule 61(5) retrospectively from 1/7/2017. Both sub-rule 4 and 5 have been amended. And the idea, if you carefully see the very language of sub-rule 4, idea is basically to now practically treat 3B as a return under 39, as if it is in lieu of 3. It is at par with 3. And this is how the retrospective amendment is being made. And the purpose is very clear, to deny the credit beyond the time limit set under section 16(4). Because if the 3B becomes the return under section 39, then automatically the 20th October, which is the date for the September return for every financial year, automatically will become the due date for furnishing the return under section 39. If the 3B is given, and therefore beyond that the credit cannot be taken. Now, whether this is valid, there are a number of reasons to say that even today 3B cannot be considered as a return in lieu of 3. One, GST Council's earlier, the flip-flop on this matter clearly says that 3B cannot be considered as a return in lieu of 3. This retrospective amendment, which affects and takes away my valuable right to avail the ITC, the validity of this retrospective nature of this amendment itself is under challenge. And there are other arguments, but these are too intricate. But the two part is very clear. 3B was never conceived to be a return in lieu of or at par or as a replacement of 3. For all these years, Council had made the departure within 20 days only. And thereafter, for 2 years, they did not do anything. Having said so, because it is not a return in lieu of or never conceived to be in lieu of, the retrospective amendment made, the validity is definitely under challenge. And once we come to the conclusion that 3B cannot be considered as a return under section 39, then 2 out of 1 alternate dates, one out of 2 alternate dates is not determinable at all. Which are the 2 alternate dates under section 16.4? Due date for furnishing return for the month of September of the next financial year, or due date for furnishing of the relevant annual return. Unless both these dates are determinable, the question of applying section 16.4 does not arise at all. Ultimately, I have to decide whichever is earlier. For deciding that, both the dates should be determinable as per the section 16 itself, section 16.4 itself. If 3B cannot be considered as a return under section 39 or for the purposes of section 39, and the 3 being already under suspension, the one date is not determinable. That is due date for furnishing return under 39. If that is not determinable, then section 16.4 cannot be made applicable at all. It becomes impossible to be implemented. For the similar reason, there is a serious case for challenge to the levy of interest under section 50 subsection 1. Because section 50 subsection 1, the interest liability is also intricately linked to the filing of the return, annual return under section 39. And because that return is nowhere in the site, 3B being not the return under 39, and 3 is already under suspension, one can seriously argue whether interest is recoverable at all under section 50 subsection 1 on the delayed payment of tax. But one of the recent cases which has been argued on this Karnataka High Court in pending is Bagmane Developers, where the High Court has issued the notice. Here also the time limit, there were multiple issues involved here in this particular case. Applicability of the ratio of the safari retreat, then 16.15 retrospective amendment, the validity of the time limit prescribed under 16.4, 36.4. These are all substantial issues involved in this particular case, where High Court has been pleased to, direct the retention of 10% of the some 60 crore demand, 10% by way of to retain in the electronic credit ledger, permitting the use of the rest of the credit. And the matter has also been finally was fixed for hearing on 2nd of December, but somehow or other it has got adjourned. I think it may come up. This could be one of the first major judgment which would be coming up on this issue. But the fight will be on. But today, to conclude, in my personal opinion, today 16 time limit is not applicable, nor can be made applicable, because there is no mechanism available for determining the due date for furnishing return under section 39, because 3B is not the return for the purposes of 39 at all, and the validity of the retrospective amendment obviously is under dispute. That being the case, even for 17-18, it is permissible to take the credit even now. Forget about 18-19, 19-20. even for 17-18, in a genuine case, if the ITC is not taken, that credit can be taken by the taxpayer. That is my personal view. These are all highly complex and the dispute-prone issues. I am aware of that, but this is my personal view. Next. And finally, 36.4. The question 36.4 about the restriction for availment of credit not more than 10% in case the vendor's invoices are not actually available on the 2A. This is basically the case. Next. 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 Now, in all these cases, here also these particular provisions has also undergone lot of amendment after this new invoicing system and 2B coming into force. We will have to see, because 2A is ultimately a dynamic return. So we will have to see. The question is, this is one provision which under no circumstances can stand the scrutiny of law. There are challenges pending in Bagmane case also, and another case of Calvin Klein case also, Karnataka High Court. The challenge to validity of 36.4 is already pending. First of all, in my personal opinion, 36.4 is ultra virus section 16. For the reason that section 16, subsection 1, which allows the registered taxable person to take the ITC on any inward supply of goods or inputs or input services or capital goods, which allows, it says, subject to such safeguard conditions or which may be prescribed. Now, it only permits the central government on the recommendation of the central government to prescribe the condition or safeguard for grant of the ITC. Can it take away directly my right to take the credit altogether? Can central government, in terms of section 16.1, empowered to extinguish my right to take the credit? In my humble opinion, the answer is no. Secondly, under section 16, there is no condition provided to restrict my credit availment based on the information of third parties. Such restriction cannot be brought through the rules, and therefore, and the rule is ultra virus section 16. In intercontinental case, Supreme Court, in the context of the reimbursable expenditure, has upheld the decision of the Delhi High Court that if the rules framed are for the purpose of the enforcing the statute, cannot go beyond the statute. Rule 36.4, restricting my credit to the extent provided therein, is basically going way beyond the section 16 of the parent statute, and therefore from that perspective also it is an invalid piece of legislation. Again, condition of matching of credit and restriction is found specifically covered under section 43 and 43A, and such source of power, such a rule cannot be found in section 16.1. Section 16.1 has, basically 36.4 has no father, no parents at all, no Gangotri, no Janes. It has no source of power whatsoever. It on its own, it cannot stand the scrutiny of law under any. It cannot stand on its own legs otherwise. It has no support at all. This restriction, even for section 43A, which was yet to be notified when the 36.4 was inserted. And 36.4 and the board circular also is also contrary to section 37 GSTR1 and section 42 also. And finally, it is unreasonable. The moment I receive the supplies under a taxable invoice on which tax is charged by my supplier and all attendant conditions when I am fulfilling, my right to avail the credit is accrued. Once that right is accrued, that right cannot be taken away or affected adversely in any manner through the subordinate piece of legislation. The ratio of the principle laid down in Aisher and Daiji Karkaria by Supreme Court fully applies. And the credit restriction on the basis of the acts of the supplier on which the recipient has no control is also violative of Article 14. So looking at it from any perspective, even going forward, 36.4 is otherwise also incapable of implementing, and it is highly discriminatory in nature, because if the total quantum of credit which is involved in the vendor's unreconciled invoice, the invoices which are not appearing in 2A, which are unreconciled invoices, if the total quantum of credit involved in those invoices and is less than the 10% of the reconciled invoices, 36.4 will not come into play. Please see the board circular explaining by way of a illustration where the 36.4 will not come into play when 20% was brought down to 10%. So there is a clear discrimination. This 10% has no logic. Third, that what happens when the supplier actually posts the invoices, because it's a dynamic return. 2A is a dynamic one. I mean, return I'm using in a very loosely word. It is not a return as such. But what happens, suppose in a given month, permutation combination can be infinite number. In a given month, there can be 5 suppliers. Between them, there can be 5 invoice, 50 invoice, 20 invoice, 100 invoice. Some of the invoices may not have actually for 5 suppliers, invoices may not have appeared on the 2A. So I have to restrict my credit. What happens in the subsequent period? The one or more supplier actually ultimately makes good the defect, the error or lacuna, whatever, and they remedy the situation by uploading the one or more invoices which were not uploaded. On what basis I have to take the credit? What is the mechanism provided in law for taking subsequently the credit when the earlier defect or error is made good by the supplier and more than one supplier? Say, am I supposed to take the full credit? Am I supposed to take the partial credit? What is the mechanism? Nothing, because those invoices remain unreconciled. Can I take the full credit in the next month if out of 5 invoices, 2 invoices have been later on uploaded in the subsequent month by the supplier? There are no answers to this in my personal opinion. Therefore, this particular provision is also discriminatory. It is leading to the anomalous and absurd situation. Looking at from any perspective, this rule cannot stand the scrutiny of the law. And the worst part was that the GSTN portal had actually washed off their hands that we have no mechanism to control it. Now something is being done about it and some red flag or something is getting alerted. However, so it is left to the party that you apply 36.4. And board circular was very clear on this. It is expected for the taxpayers to comply with this particular provision. So looking at from any angle, 36.4 is not basically can stand the scrutiny. It is absolutely invalid, impractical, unreasonable, discriminatory, unconstitutional, and ultra-virus piece of legislation and cannot stand the scrutiny of the law. Next. So I've covered this finally. Next. So friend, next, yeah. So thank you, friends. This covers, as I said, that I would not would not have been in a position in any case to take up the e-invoicing. Maybe sometime in future. In the beginning, I had actually talked about Pandora's box, and I know with this 2 hour discussion, some of you might feel that I have opened up the Pandora's box. Pandora's box is basically the expression which normally we also occasionally use in our daily, regular interaction also. Some of you might be aware about the myth, very interesting myth surrounding this Greek myth surrounding this Pandora story. Let me share with you for a couple of minutes, and then I will, give it back to the organizers. Once upon a time, there were 2 brothers, Prometheus and Epimetheus. Prometheus stood for the foresight, and Epimetheus stood for the hindsight. These 2 brothers were given the mandate to basically, distribute the different traits or quality to the animals of the universe. So they went on the task and they started distributing different quality or different traits to the different animals. When it came to the turn of the main human being, they were slightly in a dilemma, because human being the supreme animal of the universe, they needed to be given something extraordinary. But they had run out of the stock and they had nothing to be given to the human being. And because of that, then Prometheus went to Zeus and he stole fire, and fire was given to the human men. Prometheus was captured, and Zeus was very angry because he knew, and Zeus therefore summoned all the deities one day. And actually, Prometheus, in his imprisonment, in his incarnation, in the, as we call, prison, was tortured to no end. Every day, a vulture would come and eat away his liver, but he had a blessing or curse of immortality, so he would still survive. His pain and his torture continued. This misery continued till he was relieved from this by another 12 days war. The 12 days war is another myth associated with this Pandora story. Continuing with the original myth story, in spite of all this torture inflicted upon Prometheus, Zeus was still not satisfied. His sense of anger was not satisfied. His sense of revenge was not satisfied. So he summoned all the deities and asked them basically to create Pandora. Pandora is a word, basically Pandora was a woman. And with due respect to all the, lady member participants who are there in this webinar, the particular, that proverb that hell hath no fury like a woman scorned. A woman who is angry is probably much dangerous than the angry tigress. So hell hath no fury like a woman scorned. This particular proverb has its genesis in this Pandora story, because when Zeus wanted to take the revenge, he actually, driven by vengeance, he actually remembered woman and he allowed the Pandora to be created. So every deity gave something to the Pandora, and with this, like a dowry bag, Pandora box, Pandora was actually sent to Epimetheus. Now, Prometheus was knowing about what was the Zeus' plan was. So he had actually warned his brother to remain away from Pandora. But obviously, this is a myth. Pandora must be beautiful because this is a myth. This is a golden story. So, and in those days also, probably it was a dil hai ke manta nahi. So ultimately, his brother fell in love with Pandora. They got married. Another warning his brother, who was actually facing the imprisonment, had actually issued to his brother was, another caution was, never allow Pandora to open the box. So this he had taken seriously, and Pandora was asked never to open the box. Because Pandora was asked not to open the box, and Pandora was a woman, with due respect, she had to open the box. And therefore it is said that curiosity killed the cat. This proverb has also its origin in this Pandora story. So Pandora opened the box, and out of that box came out all sorts of evils and all sorts of ills, misery and disease, pain, and what not. Till that time, mankind was actually living in a very blissful state. They had never experienced such miseries in their life. After Pandora's misadventure, all these miseries and evils actually engulfed the entire mankind. Pandora was afraid. She immediately shut the box. When all these things came out of it, she immediately shut the box, and one thing remained inside which could not come out because Pandora suddenly closed the box. For an interminable period, suffering of the mankind continued on account of the Pandora's misadventure. After this period, long period, Pandora again had an occasion to visit that box. She again opened that box, and the one thing which had remained inside that came out, and that thing was hope. It was the hope which had not come out of this thing. And that's why it is said that in difficult times, in challenging times, in the miserable times, like let us say like COVID-19, these are challenging times. Everybody is, sailing in the same boat, but everybody is facing the different storm, as I would put it, under COVID-19. We are all sailing in the same boat, but we are facing different storms. Anyway, so in these challenging times, it is the hope only which keeps us kicking and alive. 2 hours deliberation on certain complex, intricate, and highly disputable issues. Whatever deliberations I have made today with my limited understanding of the law, if I have made your life difficult or miserable as a tax professional, I am sure hope will keep you kicking and alive. Thank you. Thank you for patiently listening to me. Thank you very much.
Thank you so much, Shailesh sir. So it was very wonderful listening to you regarding GST provisions and various interpretations, and then so many things. And we have a couple of queries, sir. Shall we take the question and answer, sir?
Yeah, please.
So Surya Kanta is asking, like, a man from UK orders a product worth 50 lakhs through the website maintained in India, and in return, Indian entity orders it to China. Uh, Indian entity orders it to China, ships the material directly to UK, but the payment happens from India. What is the GST liability with respect to this transaction?
Yeah, as I had already clarified this in a passing during my talk. There is no GST. There was never a GST liability on this, but now Schedule 7, Schedule 3, entry number 7 or 8. Just give me a minute. This is an out and out supply, which is happening from one non-taxable territory to another non-taxable territory, that is Japan to US, without the goods getting entered into the India. So entry 7 says this has been inserted effectively from 1 February 2019 by CGST Amendment Act 2018. It clearly says supply of goods from a place in the non-taxable territory to another place in the non-taxable territory without such goods entering into India. So this is under Schedule 3. But even in my opinion, as I've clarified, this liability never was there. Fortunately, there are a couple of advanced authority ruling also which took the same view. But anyway, these are Jotun India Limited and others. So this liability was never there, and therefore legal position was always very clear. So this particular insertion of the entry in Schedule 3 is also retrospective in nature. This is my clear view.
Okay. So next question is from Mr. Lokesh. So rental income from residential property is 15 lakhs, rental income from commercial property is 3 lakhs, and interest from SB and FD interest is 5 lakhs. So whether need to take registration for rental income for commercial property of 3 lakhs?
Yeah, this is a common problem being faced by many people, because 15 lakhs is a residential property renting which is exempted under a notification. 5 lakh is the commercial property renting, and there is a 3 lakh is the interest on deposit. 3 lakh or whatever
Okay.
it may be. 5 lakh or 3 lakh, I don't know. I mean, sorry.
3 lakhs is from commercial property.
And 5 lakh is from the interest.
Yeah. 5 lakh is from
Now, if you go by the aggregate turnover criteria, because Section 22 subsection 1 speaks about aggregate turnover, then all these three will have to be clubbed together for determining the 20 lakh or 40 lakh, depending upon the character of the profile of the supplier. However, if you see, no doubt, residential property rental will have to be included because it is exempted under notification and wholly exempt, so it is covered by the exempt supply definition. Interest, no doubt, Savai Mahendra Rathi and that other judgment, two judgment which I had relied upon, Agarwal, both these judgments speaks about inclusion. In my personal opinion, that particular case, interest on deposit, it is a consideration. That consideration, whether the exemption notification, Section 11 can exempt a consideration, it is taking away, it is providing for the abatement in a way. The larger issue is it can only exempt the service. Service is not the interest on loan. It is the consideration for providing the loan by way of it. So if the lending itself is not a service, then the question of providing all this exemption does not arise. It is a debatable issue. One will have to take up the legal fight.
Okay, sir.
And I think there is a good chances of success on this, because this entire activity of lending cannot be brought within the scope of the taxable supply at all.
Okay. So same again, Lokesh is asking whether GST on interest from deposits have to be paid by composition registered dealer.
No, because if you see the explanation, fortunately, aggregate turnover, they have excluded specifically, both for the purpose of aggregate turnover and for the purpose of turnover in a state or in a union territory. And there is, I think, removal of difficulties order also on this.
Okay. Next
And in
question
any
is
case,
from
any case, on a sideline, let me say that if you treat the lending as a taxable activity, then interest on loan in any case exempted. That exemption is applicable to everybody.
okay.
Entry 27 of notification 12 by 2017, that is available to everybody. It is only for the purpose of inclusion in the aggregate turnover, this issue will arise. But otherwise, tax is otherwise also not payable.
Fine, sir. So next question is from Bhuvaneswari. If service is provided by a person located in India to a person outside India, and the place of supply is outside India, but the consideration is not received in foreign currency, will it subject to IGST even though place of supply is outside India?
You see, this is again a bit a disputable issue because one of the conditions for the export of goods or export of services is the receipt of the consideration in the convertible foreign exchange. Correct? Now, non-receipt in the convertible foreign exchange has two repercussions. From the RBI mandate perspective, because one will have to comply with the RBI dictate also on this, because you have to take the either waiver of or you have to actually apply for the extension. All these conditions are required to be fulfilled, number one. Secondly, that it still remains export. So the place of supply remains outside, qualifies it to be export. One of the conditions is not fulfilled. That being the case, I will not get the benefit relating to the export, attendant benefit, but it cannot be subjected to the levy of tax for that purpose. If you recall, earlier the import and export rules under service tax regime, which were later on also, we had earlier the services received from outside India and provided from outside India. Those rules were there. They were merged into another rule, and Section 67A was also amended. There was a specific provision that for the purpose of once this is export, then no tax will be levied on it. Similar provision is not made under the GST Act or rules. Having said that, or under IGST also. Having said that, the fact remains that this is an export. I have not complied with the condition regarding the foreign remittances. And therefore, you may not be able to levy the tax on me, but I will not get the benefit relating to that. This is a view which will need the testing in the court of law.
So next question is from Jayakumar. So whether goodwill received on retirement of a partner from partnership firm attracts GST?
If I recall correctly, this particular case, because goodwill is treated as an intangible asset from the income tax perspective also. And I think your accounting standard also provides for that. So it is an intangible asset. Now, what exactly happens when the partner retires? How the transaction actually happens? Please, can you repeat, please?
No, here actually retirement of a partner. So goodwill received on retirement from partnership, whether it attracts GST?
In my opinion, the answer would be no. And I think there is a European Court of Justice interesting judgment on this also.
Okay.
So this cannot be treated, brought within the scope of the supply, because it is in the nature of the contractual obligation and the the amount which is paid by way of in the context of the goodwill, one man can loosely call it a compensation. So this cannot come within the scope of the supply. It is not a supply per se. And one important point everybody should keep it in mind is every amount appearing in the credit side of your annual account on the profit and loss account, which you are actually recording as an income, every such amount does not become taxable. Today there was a question, I don't know, that member who is in my another group, he had asked that question, if there was a contract for supply of the service from the foreign party on an Indian service provider, and the contract was cancelled and the money was retained, either he received that money advance which he has kept, Indian supplier has kept it. Can it be treated as an export of service, or can it be subjected to the levy? This is basically in the nature of damages or compensation for the termination of the contract by the foreign supplier. Otherwise, it would have been gone as the export of service. My answer to this will be one, this is a compensation or damages received. Therefore, whatever discussion I did that would apply. It is not a service per se. It is not a obligation to tolerate an act. So it is not a supply at all. One, it is a money which I have received. And secondly, so I need not go into whether it is an export of service or not, because service has never taken place. This is a consideration which I am receiving in some form. And secondly, for every income appearing on my annual accounts or balance sheet or profit and loss account, I need not actually look for the underlying supply with a magnifying glass and then justify the levy. You know, we are so much awed by the GST regime. The fundamental principles governing the GST are more or less the same as they were governing the excise, service tax and customs. We are all trying to look at, with due respect, at GST with a new prism and new glasses. And there we fall into the error. You know, the basic concepts remain the same, and therefore all the previous judgments of the Supreme Court in the context of VAT, excise and service tax will sooner or later will come into play, barring some cases, exceptional cases. And this is a common mistake we are making for the cross charge. Suppose, just to further elaborate on this point, cross charge has been one of the most hotly debated issue. If there is a liaison office of a person registered in one state in another state, or there is some office where one peon is actually kept by him to arrange for the director or officer going there for hotel booking and all, and you are actually, the company is debiting all these expenses of that liaison office or otherwise, but that other establishment in another state is not engaged into any taxable supply whatsoever. It is simply considered a administrative or liaison office. Merely because of that, it is two establishment of the same person in two different states. It is distinct person. Will the cross charge be invited just because I am debiting the expenses? In my humble opinion, no. Because the entry 2 of Schedule 1 says supply of goods or services or both between the related persons or distinct persons for a without a consideration. There should be supply. There should be supply first. Where is the supply? Merely because I am distinct person, legislature has a right to deem something as a supply even without consideration. But you cannot invent the supply. We are all trying to invent the supply and then justify the cross charge. This is my humble view.
Next question is from Lokesh. What is the GST liability?
That is,
Last question, sir.
Yes.
yeah.
So, what is the GST liability on commission received from foreign country?
This has been, after this 2014, the reverse charge mechanism, I would call it reverse charge.
Yeah.
Yes, because earlier exporter, the commission agent based in India, providing services to the foreign principal, were coming within the scope of export of service, right? And the principal based in India, availing the services of the foreign commission agent, were required to pay the tax under the reverse charge. In 2014 October, this entire provision underwent the somersault, and a reverse provision has been made applicable, whereby a foreign principal availing the services of the Indian commission agent, paying him in the foreign currency, the Indian commission agent is required to pay the tax. And conversely, if the foreign agent providing the services to the Indian principal, though it is under reverse charge, import of services, the place of supply will be foreign country because he is situated there. No reverse charge will be applicable. This is a very absurd and funny situation. I know that. Unfortunately, this has been continued. The legacy has been continued in GST also. Only recently, the challenge has been made before the Gujarat High Court on this. Some other high courts are also, the challenges are already there. This is ours is probably the only country in the world, probably, I may be mistaken, but my reading says only country in the world which has actually applied this reverse charge mechanism, which is against the destination principle fundamentally governing VAT. And if it is touched on the touchstone of if it is tested on the touchstone of the destination principle, which is the fundamental character of the VAT or GST, I doubt whether this provision will be upheld by the court. Merely on the ground that this is a legislative policy. We'll have to wait for the judgment. But otherwise, today the liability exists.
Fine, sir. I think only
Yeah.
participants we had. And I request Chairman of Bangalore Branch, Sri Ravindra S. Kore sir, to deliver vote of thanks.
Yeah. Sir, it was unfortunate to have the on 14th May, we had a session from Raghuraman sir. It was on 20th session. And again on 37/2020, Bangalore branch had its 45th session from Vaideshwaran sir. 45 into double now, today is a 91st session. We are hearing from Shailesh sir. It is a coincidence. All the three dignitaries we have truly served for Jnana Dasoha. The today's Jnana Dasoha is specifically remembering and recalling because Raghuraman sir and Vaideshwaran sir, frequently we are hearing from them. And today we have got an opportunity from you, sir, from Mumbai. I must thank CABB Chandragi from Belagavi, who has rightly advised us. So definitely our members have got true Jnana Dasoha from Shailesh sir. The experience, what it speaks, sir, is when delivering his lecture, the automatically the how much experience he got in the field and experience that is the definitely reaching to the our members. I'm wholeheartedly thanking you, sir, on behalf of Bangalore branch,
No.
all the viewers.
No.
Uh,
It's pleasure. It's a pleasure and privilege has always been mine. I'm sorry I could not take the last topic, but this topic would need a lot of deliberation because e-invoicing is a very, very serious and revolutionary concept. And I'm sure the branch in the coming days would be discussing
sir,
about it very often. And one should really understand where it is going. Right?
Yes, sir.
So,
Definitely,
yes.
we
So
will
I
have
could
it,
not
sir.
take up that particular topic, but once again, it is my pleasure and privilege to be with you today and thank you for giving me this opportunity to further, study and fine tune whatever limited understanding I have about these particular subjects.
Thank you, sir. Thank you very much. So, as members, I mentioned 22nd, we are having our next session, professional opportunities for financial options for MSMEs. So, with that note, I request Panindra Gupta to render formal vote of thanks to the speaker and all the viewers. Thank you, Shailesh, sir, once again.
Thank you very
Vote,
much.
Panindra.
And before,
Vote.
just only by today night or tomorrow, I will be sending my complete PPT fine tune. There are some three
Yes,
couple
sir.
of mistakes, and which you can then later on circulate not only in the participants to everybody. Yeah, I would
Yes,
be
sir.
Sure, sir.
We
We will be
are,
uploading in website.
the website
Yeah.
and everything. Please, sir.
yes, sir. Panindra, please.
Yeah. On behalf of Bangalore Branch and the entire managing committee of Bangalore Branch, I thank today's speaker, Sri Shailesh Seth sir, for who addressed today's session all the way from Mumbai. Thank you so much, sir, for your valuable time and insights.
Thank you, this pleasure is mine.
And all the viewers who have attended for today's session, I wholeheartedly thank all the viewers and keep watching to Jnana Dasoha web series from Bangalore Branch. Thank you one and all.
Thank you.
Thank you, sir. Shailesh, sir. Thank you.
Thank you very much. All the very best.
Thank you.